Good day, guys. This is the part 2 of Introduction to Forex Trading. This is the part 2. So we'll get straight to the point. The last time we stopped at trading size. Trading size. Okay, the last time we stopped at trading sizes. Today we'll be looking at pips, pips and value, and some other basic terminologies in trading. So let's go straight to the point. We have the pip and pip value. So what's a pip? What's a pip? A pip is the smallest amount of change in a currency pair. For currency pairs displayed in, let me put my slide. For currency pairs displayed, okay. For every currency pair displayed in 4 decimal places, a pip equal a change of 0.0001. Yen crosses are displayed in only 2 decimal points, and 1 pip is displayed in these crosses equals 0.01. This right here is an example of a pip. I also have pipettes. But for yen currencies, they are only displayed in 2 base decimal points. But for pips, they are displayed in 4 decimal places. But for yen crosses, they are displayed in this value. Now, what of pip value? What's the pip value? In the previous example, the increase in euro US dollar was 0.0100 or 100 pips. Now, this is an example, this is 100 pips, right? Or 0.0100 or 100 pips. The profit will be $100. So for each pip, each pip has value of $1. And if your position is, let's say if my position was 1 lot, the profit will be $1,000, and that's 100,000 units times 0.0100. So for 1 lot, the pip value will be what? $10. So you can see the basic calculation of the pip value. This is how to basically calculate your pip value. For calculating pip value, the formula, sorry, I'm an economics student. To calculate your pip value is simply what? Pip size times the position size. For example, let's say you are using a lot size for this currency pair, which is euro US dollar. That will be giving you, let's say you're using 1 lot size. Sorry about this. Okay. Let's say you are using 1 lot size for this currency pair, euro US dollar, which is 0.0001 times 100,000 units. That will be giving you what? $10. This is a very simple and straightforward formula for calculating pip value. Now, if I want to convert the pip value in terms of the base currency, like I told you, the base currency is the first currency and the second one is the quoted currency. That will be giving you pip value. The pip value will not be what? The pip size times what? The position size. I don't want to bombard you with too much of this mathematical formula or stuff because we are simply just here to, we're here for something else. Okay, so let's get straight to the point. So if I want to convert the pip value in terms of the base currency, I'll be doing pip size times the position size. And if, just like the example here, if my account is in pounds, but I want to know the pip value in pounds, you will change the dollar pip value using the Great Britain pound against the US dollar rate. So for 1 lot, you'll be doing 10. You'll be doing 10. That will be Great Britain pound divided by US dollar. But in order not to bombard you with too much grammar, this graphical representation, this is a simple graphical representation of how to calculate your pips. Just like you can see right here, we have 5 decimal points right here, and the fifth one is what? 0.1 pips. The second one right here, the second decimal point, which is this 6 right here, is what? 6 pips. The third one gives you what? 40 pips. The fourth one is what? 900 pips. The fifth one is 1000 pips. And this first one after the point is what? Before the point, sorry, is 10,000 pips. Now, we have some other examples of pips, which is the fractional pip. So some brokers offer 1 extra digit in order to provide more precision. Just try to read more about this. I don't want to dig too much into that. So pip value is how much one pip is worth in monetary term. How much is one pip worth in monetary term? If you have to put it in monetary term, how much is one particular pip worth? So that's what pip value is simply talking about. And to know how much it is worth, it depends on three main factors. It depends on three main factors. And what are the main factors that determines that? We have the currency pair. That's the first one. We have the currency pair. We have the exchange rate, and we have the size of the trade. Now, in conclusion to this, position size is in terms of the base currency, but the P value is in terms of the variable currency. And like I told you in the other video, the variable currency simply means what the quoted currency is the quoted currency. Just like we have our currency pair, let's say the Euro USD, Great Britain Pound USD, we have the Japanese yen against the Great Britain Pound, we have the Nigerian Naira against the US dollar. So the second currency is what quoted currency, and the first currency is the base currency. Let's go into the next main terminology, which is the market order. This is a very important term for you to understand in trading. Now, talking about the market order, what is the market order? Market order, it is an order to buy or sell immediately at the market price, immediately at the current market price. Market order is an order to either buy or sell immediately at the current market price. When you push a button and enter a short or long position immediately, when you push a button to either short or long, and like I told you in the other video, once you hear short, it simply means to sell, and once you hear long, it simply means to buy. Once you push a button immediately to either long, let's say long Euro USD, it means you are what? Buying Euro USD, and the market will put you into that position immediately. And exiting the position with a button push at current market price is also a market order. That's very simple and straightforward. Now look at this example I gave right here. Now you can see this graphical example of the button. Immediately you press buy, market gets you in immediately. Now, what are the example of pending? Once you see a trader post example, buy gold now or buy XAUUSD now, it means you should enter that market instantly. You should enter the market instantly, and you will be quoted at the current market price. Now, once you see just example of crypto traders, the example that they mainly use, you see them using examples like limit order, this and that, enter future trade. Yeah, it means you're not entering immediately, you're entering later. You're entering the market later. Like, let's see the example of pending orders to actually enter. You must have heard of buy stop, sell stop, and all of that stuff before, but you basically don't understand what they are about. Now, in this video, I'll be breaking it down for you. Now, once you hear a buy stop, let's say you get a trade on buy stop XAUSD. It is a pending order to buy at a price that is higher than the current market price. Let's say the market has been buying, and above a resistance level, there is a buy stop there. It means once market is able to break that resistance level to the top side, your trade will be triggered immediately, and you will be able to continue buying. It means what? You've entered that trade, but you didn't enter at the current market price, but you entered a pending order. That market should, if market continues in this format, I also want to be quoted in, and I also want to join in this trade. That's just the simple example of a buy stop. Let's say market has been buying or market has been selling, and you set a sell stop. A sell stop means you're setting. It means for you to set a sell stop, the market is selling, and you expect market to sell below a particular limit. If market sells below that point, and you're like, what? I want to join this trend. I want to join this current market trend. That's simply what a sell stop. That's simply what a sell stop is all about. That's simply what a sell stop is all about. Now, talking about buy limit, a pending order to buy at a level below the current price. For you to enter a buy limit, let's say the market is currently selling, and you see a support level, just like the simple rule, buy when the market is low and sell when the price is high. Now, for buy limit, it means the trade is currently selling, and you are like, what? At this point, if this trade continues selling up to this level, I want to buy. If it sells up to this level, I want to enter for a buy. That's a pending order to buy at a particular level that is below what the current market price. And the sell limit is just vice versa of the buy limit. It's a pending order to sell at a level above the current market price. And this is a graphical representation that will be explaining this deeper. Just like you can see in this chart right here, this trade was selling, this trade was buying, this trade was buying, but it set a sell limit here that once market gets to this level, I want to sell. Market got there and started was spiking downward. Another person set a buy limit that once market sells up to this level right here, I want to start buying. And did what? It got triggered. So that's an example of sell limits and buy limits. And I hope that's very much explanatory now. Now, what are the pending orders to exit? Now, those are the buy stop, sell stop, buy limit, sell limit. They are pending orders to actually enter, a position. Now, what are the pending orders to exit? To exit a trade or to exit an order. Now we have stop loss. This is an order to exit if the market moves against you. If the market moves in the opposite direction of your position, it is set at a specific level in the opposite direction of your trade. Let's say you're selling. You enter a position to sell. Let's say you enter a position to sell Euro USD, Euro US dollar. You enter a position to sell. Now, at the point where market is selling, your stop loss has to be above. That means if this trade does not continue selling and it starts buying, market should close me out at this point. I'm no longer interested in holding this trade. And it helps to do what? Minimize your loss and maximize your profits. And that's the main goal. And just like an economist term that we're taught, I'm very, very much familiar with, which is the main goal of an economist is to do what? To minimize costs and maximize profit. That's the main goal of every business trader. Now you can see this graphical representation right here. And what of take profit? We have the next one, which is take profit. Take profit is an order to exit the market. If the market moves by a predetermined distance in the direction of your position, you set a take profit at a specific level you want to realize your profit. Let's say you set a take profit, you set a trade, and you're like, okay, once I'm in this particular profit, once I'm up 100% or once I'm up 80%, I want to get out of this market. I want to take my profit and just close the trade. That's a take profit. The market's order. The market closes you out at that point, and you are what? The market takes the profit that you've been able to accumulate at that point where the order was triggered. I also have another pending order to actually exit a trade. We have the trailing stop. This is a modified stop loss that as long as the price moves in the desired direction, the stop loss order automatically follows the market by a specific distance. Now, just I think this directly opposite break even, or more like a break even. For example, if you are in a long position, I can place a trailing stop which is set at 20 pips distance below the price. If I'm in profit, my stop loss will keep reducing. But if I have any kind of reversal, the disadvantage is if there's any kind of reversal, it will automatically hit my trailing stop and my trade will be exited. And if the price continue moving in my direction, I'm already out and I won't be able to make any extra profits. So that's just the basic example of a trailing stop. That's the basic example of a trailing stop. Until now, we refer to an exchange rate as being quoted in one price. In practice rather, things are different. When you start using a trading platform, you will see that exchange rate are quoted in two price, which is the first one is the bid price, and the second one is the what? The second one is the ask price. The first one is the bid price, and the second one is the what? The second one is called the add price, the ask price. Now, the difference between the bid price and the ask price is called the spread. It is your cost for entering a trade. Yes, the spread is your cost for entering a trade. The spread is your cost for actually what? For entering a trade. And just like you can see this graphical representation. Now, I will be explaining bid, ask, and price. These are the basic terminologies that you must understand as a beginner to be able to navigate the FX market successfully. Now, a Forex swap or a rollover, when you hear swap, What does the swap simply signify? A forex swap or a rollover is the interest added or deducted for holding a position open overnight. Let's say, and that's actually charged by the broker. Let's say from Wednesday to Thursday, the swap is tripled. For example, the swap rates are calculated as the overnight interest rate differential between the two currencies. Now, swap rates can potentially generate extra profit or loss to one's trade. Yeah, they generate extra profit, either extra profit or loss to one's trade. And it is the interest added for holding a position overnight. I hope that's very, very clear and understandable. Like just like you can see right here, yeah, I was giving an example of base and quoted currency in my previous video. And you can see right here, Great Britain pound as the first currency is what? Great Britain pound against the US dollar. That's a currency pair. Great Britain pound in this example is the base currency, and the US dollar is the what? The quoted currency or the counter currency or the variable currency, whatever you want to call it, that makes it much more easier for you. I can see now this is a perfect example of a pip and a pipette. A pip and a pipette. Now, look at this example. Great Britain pound was quoted at 1.4089 and a minute 3. And the US dollar was quoted at 1.40409 and a minute 4. 4. You can just call it 4. Don't mind me. So the bid, this is the bid price. The sell or bid price. The sell price is the bid price and the ask price is the buy price, just like you can see right here. Now, the difference between both of them, the bid price minus the ask price, is what spread. If you open your broker on your phone, whatever broker you're using, but just make sure you're using a good broker in order to be able to minimize your loss and to maximize your profit. That's just the benefit of using a broker. In my upcoming videos, I'll be adding my link to it, my broker link, the broker I recommend, XNES, either XNES or Access Market. But Access Market is actually much more better, much more better. Now, the second number, the second digit in your price tag is your PIP. And the last one is your pipettes, just like you can see right here. This is very much clear and understandable. You must have been hearing pipettes, and you don't have the basic understanding of what a pipette is. This is a graphical, this is a, this is a very, very good illustration of what a bid price and a ask price is. Now let's go into the next. Now, what are the more key definitions? The more key definitions that you need to understand as a beginner. Now we have the balance. It is the amount of money that you have in your account. If you simultaneously close all your position, it is the amount of money that you have in your balance. The amount of money that you have in your balance. Your equity, when you are in a running trade, let's say you are in a running trade, your equity is what? Your balance plus either your profit or your loss. If you are making a profit, it will be added to your balance. So if you see that your equity is higher than your balance, it is because what? You are currently in profit. So the addition of your profit and your equity and your balance is what gives your equity. So equity simply equals to what? Profit plus balance balance plus profit or loss. If you are making a loss as well, you will see that your equity will be lower than your balance. And if you are making profit, your equity will be higher than your balance. In the previous example, your balance is, let's say for example, $5,000, but your equity is what? $4,800. In this example, it means what? You are currently down $200. So that's just a very, very simple analogy. Now, your equity is the amount of money you have in your. Okay, what's this? Okay, still under your balance. It is the amount of money you have in your account. Unrealized profit or losses are ignored in your balance. In your balance, unrealized profit or loss. It is when you have closed your trade, whether you now end up making profit or loss, that will now reflect in your balance. Let's say, for example, you have $5,000 in your account and US and $200 unrealized losses from open trade. Your balance will still remain $5,000. But when you close that trade, you will see an automatic deduction of what? $200 from your balance, leaving you with only $4,800. And this is a very, very nice picture. I just tried as much as possible to get good pictures for you guys. So talking about equity, this is the last slide. Equity is the difference Equity is the difference of your equity and your open position. Okay, margin. Margin is the difference. I've explained equity already. I've explained equity already. Now, talking about margin, margin is the difference between your equity and your open position. Margin is simply the free margin is equals to your equity minus margin. Your margin is the amount of money you have left in your balance to be able to what place another position, to be able to place new trade. That's just very, very simple and self-explanatory. So for example, let's say you want to open one lot of Euro USD at 1.0500 and you have $10,000 in your account. Using 1.0100 leverage, your margin is what? 1,050 US dollar. So your free margin is 10,000 minus 1,050 there, and leaving you with the balance of what? 8,950. That is very, very simple and straightforward. Non-star effects, pips and progress, profit is our language. I hope I've been able to break everything down about the introduction, the deep introduction to FX for beginner, full guide. And I tried as much as possible to break everything down and explain everything, the whole terminology, making it very, very simple. And what are the benefits of trading Forex? You necessarily don't have to work 247, but it requires a lot of attention. It requires a lot of effort, consistency, discipline. And at the end of the day, you'll be able to make it big and make good profits. So uh, that is all for now. I'll be dropping a lot of nuggets. My next video probably might on FX for beginner will probably be on candlestick. Yeah, that's the next thing. So make sure you watch this video over and over again. If there's anything you don't understand, make sure you rewatch, share with your friends, family, and loved ones. If you are yet to subscribe, ensure to do so. Like, subscribe, comment, um, and share. Share with your friend. I've explained all of these terms, and I tried as much as possible to break it down. I tried as much as possible to break it down. So if you have not watched the first part, make sure to watch the first part. I'll actually be creating a playlist with this example. If you have not watched the first part, make sure to watch the first part, and you can also join my Telegram channel, Nostar FX Forex, and YouTube, Nostar Forex. I'll be posting a lot of educational content for you guys. Make sure to stick around, subscribe if you are yet to, and God bless you. Thank you very much. That will be all for now, guys. I hope to see you on the other end. Yeah, thank you.